being here. I really appreciate you taking your time, from your busy schedules on Thursday to come see Jordan and I. Um, I am going to talk tonight really about the top five tax changes that have come about because of the OBBA and what it really means for your tax situation. I want to introduce myself first. Thank you, Jordan, for the lovely intro. My name is Alexis Scalati, and I am the founder and lead tax strategist at Cerebral Tax Advisors. I hail from Knoxville, Tennessee, where we are about to go through the snow apocalypse. Apparently, for those of you in the South that know how crazy things in the South, where it's nothing for Jordan up in Buffalo, New York, but I have over 20 years of experience in the tax industry. I was born in a physician household, and I'm married to a private practice neurosurgeon here in the Knoxville area, and enrolled agent, have my MBA, master's in tax, all the good things you see on the screen. Basically, I love talking tax. I love teaching tax, and I'm really excited to discuss everything with you tonight. So first, we're going to talk about what is the OBBBA and why it came about. And we're going to go through, like I said, a number of items, such as the provisions that were made permanent from the first act that Trump put in when he was first in office, and TCJA. We're also going to talk about probably the most popular item that came about from this act, bonus depreciation. We're going to talk about opportunity zones, the state and local tax deduction changes that have occurred. My new favorite, which are called Trump accounts. Hold on for that one. That's a great one. I love it. We're going to talk about estate tax and some high net worth planning as well changes. And of course, it's not complete unless there's bonus. And so I really want to talk about some other noteworthy changes and key planning opportunities. So let's get started. So the OBBBA, or the One Big Beautiful Bill Act, was signed into law last year. And it was really a major tax and spending legislation that impacts both individuals and businesses. So it extends many of the provisions of that first act that was passed by Trump in his first part of his presidency. And so we're going to talk about a few of those items, but it also affected, individual rates, some deductions, credits, business incentives, estate planning, and some investment strategies. And so it was just a very big act that kind of touched a lot of places. And it's going to be important to note that there were a number of items that actually changed, but a lot of them really don't apply to the majority of physicians, just because you guys tend to make so much more. Things like, car loan interest deductions or deductions for overtime pay and tipped money, like those are really things that don't affect the majority of physicians. So we're not going to go over those items tonight, but just know that there are another number of items that have also changed. So that might affect maybe family.
Yes. Yeah. Especially if it's for the
unmute. Can you all hear me? Am I unmuted now?
Yes, there you go.
Okay.
Sorry about that, Alexis. And then just ask everyone to make sure you mute.
No worries.
All right. Thanks, Alexis.
Great. Yeah, no problem. So yeah, there might be family members, for example, that may be affected by some of those items, but since y'all are physicians or medical professionals, I want to go through the ones that will affect you. So really, this year, you need to start working, on understanding these changes, or with your tax advisor to see which of these changes are going to affect your particular tax situation. Let's first discuss what actually was made permanent under the tax cuts. And a lot of these provisions were going to, go off a cliff or not, go away starting in 26. First was the lower individual tax brackets and rates. So the same rates for 2025 are staying. There's also the higher standard deduction. So if you remember, that increased I think this year it's going to be a little over $30,000 for that standard deduction. So if you don't itemize or you don't have enough to itemize, that's over that minimum 30,000 or so for married filing joint, then you're going to want to take that standard deduction. Also, the QBI deduction is now permanent and very crucial part in planning. Also, increased AMT exemptions and phase-out thresholds are now permanent. And so that's a very big deal because for those of you who don't know what AMT or alternative minimum tax is, when you're actually preparing your tax return, you're preparing it with ordinary tax rates. And also alternative minimum tax rates as well. And for a really long time, I mean, like since the 1970s, there was no adjustments for inflation when it came to the exemptions around AMT. And so a lot of really middle class taxpayers were hit with AMT, and that was not the intent of Congress. So the Tax Cuts and Jobs Act changed it where, these exemptions were increased to really hit the people that it was supposed to meant to hit. And now that's been made permanent and it's being adjusted for inflation. Also, the higher state and gift tax exemptions have now been so that is also now being indexed for inflation. And obviously, the main reason why this all matters for physicians is because it provides more planning opportunities, not only for current year tax savings, but also long-term estate and legacy planning as well. Okay, let's talk about the one that's probably the most buzzed about when it comes to the OBBBA Act. It restores 100% the bonus depreciation on qualifying property. And where before, if you remember, it was being phased down. So it started 100, then went 80, 60, 40, 20, then it was going to be phased out. Now it's back to 100% only for purchases after January 19th, 2025. So if you purchase something in let's say some real estate in December 31st of 2024, you're still going to have to use the bonus depreciation percentage for that year. You can't use the 100%. This is a very big deal for physicians, when it comes to equipment, imaging, practice upgrades, technology, and then of course, real estate. Those that will really allow you to depreciate, the certain improvements with those properties. So I did want to mention that if you buy, let's say, for example, $1 million building, it does not mean you get to write off $1 million. That means that when let's say you bought a piece of property for $1 million, let's say that's all goes to the building. Well, that building is made up of different components. And so those components are things like lighting and fixtures, for example. And lighting and fixtures are considered a 5-year asset. So that means that instead of, let's say, $100,000 is of these 5-year assets, then instead of depreciating that property over, let's say 27 and a half years, if it's a residential real estate, then that $1 million over 27 and a half years, 100,000 of it can actually be depreciated over 5 years. So that's where you're getting that accelerated depreciation. And so you'll get to actually write off if there's any piece of that property that's 5-year to 15-year property or asset, then you're able to write off 100% of those 5 to 15 year pieces of property. So it can still be a very big chunk. And so that's why everybody's like, yay, it finally came back. And so you want to really consider the timing of your purchase. Obviously now, if you're going to be purchasing something, you're in the clear. But you'll want to also think about too, what you're wanting to do in terms of those cost segregation studies, or taking the bonus depreciation or Section 179. Let's talk about opportunity zones. So this is a strategy to help defer and defer capital gains, and to also create additional tax savings, because the growth is considered tax-free if you hold it for a 10-year period. So let's back up and talk about what opportunity zones are. Opportunity zones exist to go and revitalize different areas of the United States that the government essentially wants to pump money into, to take it from dilapidated to being nicer, and encourage that growth. So if you, let's say, have $200,000 of capital gains, let's say you sold something for $1 million and your basis was 800,000. Traditionally, let's say, it's a piece of real estate. Then if you do like a 1031 exchange, you would have to put that full $1 million into the next building that you're going to buy, in order to defer that capital gain and not have to pay tax on it. With an opportunity zone, you only have to put in the actual capital gain. So instead of having to put in the $1 million, you only have to put in the $200,000 of the actual gain. And you can use then your $800,000 of basis towards whatever else. The beauty is that when you're investing that $200,000 into the opportunity zone, you can do it through doing it for real estate, but there's also opportunities doing it through oil and gas as well. And when doing it through oil and gas, for example, there's usually a 6% guaranteed tax-free income that comes during the year, or for each year, excuse me. And then if you hold that investment for 10 years, all the appreciation comes out tax-free as well. So it's a really great way to, again, defer the gain. And that's over a 5-year period. And year 5, then you have to pay tax on that capital gain. But then, you continue to hold it for another 5 years. And again, that appreciation is tax-free. So it's a really great deal if you don't need that money, that capital gain, to invest in other things, et cetera. And you're able to, like I said, use the basis or your principal, instead. I do want to point out, though, that 2026 is kind of like a buy year when it comes to these sort of investments. It's not until the beginning of 2027 that these new rules around the opportunity zones will start. So if you're going to have a big capital gain event, and this is something that you're interested in, try to push off that event until 2027. Okay, so let's talk about the state and local tax deduction. On your Schedule A, which is where you go to itemize your deductions, and so that's like, the state and local tax, mortgage interest, property taxes, charitable deductions, all of those make up your charitable all of your itemized deductions. And in the past, there's this on the amount of state and local taxes you're allowed to take. That was $10,000. So that really didn't affect someone like me, where I'm in Tennessee and there's no income tax in Tennessee. So we just take sales tax, and so really it didn't affect me. I could get my full property tax deduction, et cetera. Now, if you're like Jordan, who's in New York State, where there's high income tax and there's high property tax, and yes, Jordan, you should move. So if you're in a state that has high tax, what a lot of states were doing to avoid this limitation is they've enacted pass-through entity tax credits. And so what that basically is if you have an S corporation or partnership, you could write off your state and local tax through your business, and then so that would obviously lower your taxable income that would come through from your business, and then the state would give you a credit for taxes paid, because you paid basically your state and local tax at the entity level as opposed to the personal level. Now, what the OBBBA did was it changed it from $10,000 to $40,000, and that right now is through 2029, and there are going to be adjustments for inflation. So the 40,000 was for 2025. Now for 2026, it's adjusted to 40,400. But, and there's always a but, right? Especially for high income earners, there's a phase out that begins with your modified adjusted gross income. So for 2026, the phase out begins at 505,000 and reverts back to the $10,000 cap when you basically get just a little over $600,000. So that's going to be a really important planning opportunity, for you to work with your advisor to say, hey, what other things can we be doing to get us below that cap? So, excuse me, not that cap, below that 600,000. So that way you can take advantage of that 40,400 cap. Now, if you unfortunately pay more than that when it comes to your state and local tax, you can still do that pass-through entity tax credit strategy if you have that S corporation or the partnership. Now, this is really important in general, just because obviously if you have not been able to itemize in the past because you haven't been able to take that SALT deduction, you might want to think too about, going and bunching your charitable deductions together. So then that way, it's like if you normally do, 20,000 one year and then 20,000 the next year, maybe just do it all, in 1 year. So then that can help boost you above the standard deduction, and you can get the itemized deductions all together. Ooh, my favorite. This is actually my favorite change for the for the OBBBA. And these are the new Trump accounts. Now, there's still a little bit of mystery behind them, but we're slowly starting to get more information about how to enact these. And so what this is essentially another savings account for your children. And in the past, in order for your children to put money away into their Roth IRA, for example, they would have to have some sort of earned income. So if you had a business and you hired your kids, they could earn, this year for 2026, the maximum Roth contribution is $7,500 for someone under 50. Then you're able to go and, pay them $7,500 if, it's legitimate business, legitimate role. And then, you could put that money into their Roth IRA. Well, now you can still do that, but there's also this new account where parents and grandparents can contribute up to $5,000 a year to a child's account. And so that's $5,000 per child. So you can't open one for the, parents can't open one and the grandparents can't open one and then, double it up basically. What's neat as well, and that's something to think about as an additional deduction for your business, especially if you're a single owner business, is that employers can contribute up to $2,500 a year. And so that could be partial deduction as well. So it's not the full for the 5,000, but you can do part of it through your business and then part of it personally. And if you have children that are being born in 2025 through 2028, then the government is actually going to give you an additional $1,000 per eligible child. So that's something that you definitely want to take advantage of. And so, but these accounts won't start until July 4th of this year. So you have plenty of time to start looking into them and, go through to the website and get things set up. But what's important to also know is that the funds have to be invested in index funds. So they're not going to allow you to invest it in anything, alternative investments or anything else besides those index funds. And then once the child turns 18, then it's going to get rolled over into the IRA. So this is something I'm going to be definitely discussing with all of my clients when it comes to our mid-year tax planning time and starting to have children and starting this account along with making sure that their kids are properly hired through their business as well. Okay, great. So let's just talk about estate planning. This is a big deal because I was originally going to revert back to, I believe it was $7 million, per person. And now it's been, that exemption, has stayed increased and it's going to be indexed for inflation, which is great. And so it's going to be 15 million per individual. There's a lot of this you're going to want to work with your estate attorney just to make sure that, if you were to pass away, that your exemption gets transferred to your spouse if you're married. So then that way your spouse will have, the $30 million as opposed to just the 15 million. And then this permanence for the TCJA or estate provisions, creates a lot of, like I said, wealth transferring strategies as well. And so you're going to, like I said, want to connect as soon as possible with your your estate attorney if your portfolio or your net worth, is potentially going to be hitting these larger dollar amounts. Right. So let's talk about some just noteworthy changes. The one kind of, in my opinion, very annoying and I think kind of discourages people a little bit when it comes to contributing to charities is that in starting 2026, only charitable contributions exceeding 0.5% of someone's adjusted gross income are deductible for itemizers. Just like any other year, if you have more that's over it, then it will get carried forward. I'm really hoping that this doesn't discourage people. Like it really, 0.5 is very, very small, but I think it sets a precedence and I can see it maybe increasing in the future, especially them then saying like, oh, someone who is, above a certain tax bracket or a certain dollar, income earning amount, like it ends up being like tiered. So, and also too, for taxpayers in the 37% bracket, the value of an itemized deduction is capped at 35 cents per dollar. So instead of the 37 cents. So what that basically means is that, if you have, $1,000, then in simple math, like you'd be paying about, $370 in tax. However, with this, they're actually going and taking away about 2%. So you have to actually pay about 2% more in tax because essentially they needed a way to pay for these Trump accounts and some other other provisions that they have within the OBBBA. But it is important to also note that when it comes to charitable contributions, that non-itemizers may claim a permanent above the line deduction for cash contributions. So that's up to 1,000 single or 2,000 per year for joint. But this, by the way, is not available for donor advised funds or those supporting organizations. Another one that may affect a lot of physicians, because y'all love your electric vehicles, is that $7,500 credit is no longer available as basically of September of 2025. Most of the individual clean energy tax credits from the Inflation Reduction Act were repealed or sunsetted for property placed in service or acquired after 2025 or 2026. So if you're starting to look at any of those energy incentives purchases, just double check to make sure that any sort of credits still apply, because most likely it won't. So remaining credits have new restrictions, and including, disallowance for certain foreign influenced entities as well. If you have 529 plans for your children and you tend to use it for K through 12 tuitions, then what's great is that the annual limit doubled to 20,000. It used to be 10,000, and it expanded to cover more expenses other than just tuition. And so it's other, curriculum, tutoring, therapies, and testing. So definitely take a look into that. And even if you're unsure if your child is going to even be going to college, it may be beneficial for you to start as early as possible, get that growing, and then using that for, private school tuition, and, any of these other therapies or, educational curriculums. So as you can see through this, this is very much just touching lightly on a lot of the different changes that have occurred through the One Big Beautiful Bill Act. And it's really a opportunity for you to start planning more. And the earlier you start planning, the more that you'll be able to save and be able to make sure that everything, your plan is being set up properly, implemented properly, and then obviously reported properly on your tax return. And by starting as early as possible, you're able to actually see the tax savings right away, because you're not going to have as big of withholdings, or you're not going to have to make as big of quarterly payments, when you go and start planning right away. So even though there was a mix of permanent and temporary changes, the deadlines do matter. And I really encourage y'all to, go look at, the rental properties you have and see if there's, even if you do new improvements, or maybe you're purchasing a new medical building and or you're even leasing and you're doing a big build out, all of those things you can take advantage of that 100% bonus depreciation. Look into opportunity zones starting in 2027, if you're going to be having any huge capital gains, or to even think about, if that's something that interests you, think about, again, going and trying to defer those capital gains until 2027, just to give yourself that opportunity to take advantage of those opportunity zones. And then that state and local tax deduction, hopefully most of you will be able to do enough planning where you can reduce yourself below that $600,000 mark, and then, or even the 500,000, really, because remember that the phase out begins at about 500 and then completely phased out at 600. So we want you to be able to take advantage of, be able to write off as much of the state and local taxes as possible, especially if you're pass-through entity like an S corp or a partnership that would allow you to write it off through the business. And start looking into those Trump accounts. Like I said, the IRS is slowly trickling out information on how to apply for them, and where to go to set those accounts up. And luckily, it them being just index funds is great. They're low cost, and the most index funds are about a 9 to 10% return on investment every year on average for the past 10 years, give or take. And of course, as I mentioned, please go to your attorney and revisit your will and make sure that all the provisions are in place when it comes to your estate planning to take advantage of those new estate and gift tax exemptions. Well, I want to thank everybody. I'm really excited to start answering your questions. And, if you're interested in talking with me or have additional questions after this webinar, all my contact information is on the screen. And, thank you so much, Jordan, for giving me the opportunity to talk.
Of course. Yeah. Thank you so much. Definitely, as always, like a wealth of information. And I think, again, just highlights the importance of number one, working with a tax advisor and strategist, not just someone who files your taxes, but someone who's actively and proactively working to develop an entire strategy and truly knows the rules in and out. A couple questions have come in the chat already, and I encourage everyone questions related to this. Definitely, if you want to raise your virtual hand and ask with your camera on and stuff, definitely feel free to do that. If you just want to put in the chat and we'll ask, but this is a golden opportunity to basically have all your tax questions answered. There's no silly questions related to taxes for sure. So first one related to the Trump account. What's the required age of the children? Or is it just as long as they're your child, they count?
Born, yep, from when they're born to 18 years old.
Okay.
So once they turn, to 17, excuse me, once they turn 18, then the account will get shifted to an IRA.
So there, perfect. And then a question on my end, just to totally clarify, the government, like them contributing $1,000, that's for born in 2025 to 28. But
Correct.
Even kids born before or after, then you can still do the Trump account. It's just, it won't be contributed that amount.
Exactly. So like I have 4 children, ages 8 to 13. They'll all qualify for it. They just, for me being able to put in that $5,000, but they won't get the $1,000 because they weren't born between 2025 and 2028.
Perfect. Yeah. Thanks for clarifying that. And then Chris, a question related to Trump accounts as well. Are the earnings tax deferred?
Correct. Yes. So it basically acts almost like an IRA or a retirement account. It pretty much acts the same exact way. It's just called a Trump account because it has its own like set of rules, and that's why when the child turns 18, it converts to being just a traditional IRA.
Okay. And in that sense, Ashley, it's a question. So are those contributions then tax deductible in the sense that you're contributing them pre-tax?
I don't, let me check.
Mark believes no.
Pardon?
Oh, I said Mark just commented and he says no, but
yeah, correct. Yeah. Yep.
Okay.
Since they're being done with after tax, that means, so then that kind of acts very similar to, be like a Roth IRA. So then it will go and that what you put in, that principal is not going to be taxed again.
Okay. Makes sense. Just like a very I guess this is a generic question or something I just want to bring up because I think a lot of people's biggest concern about enacting a lot of these advanced tax strategies is like, am I going to get audited? Is this, legal? Am I putting a bullseye on my back and stuff like that? And me and you've guided me through one audit already, and then there's one that is ongoing, but it ultimately will be fine. Can you just talk a little bit about that in terms of like what your view is on maximizing tax strategy? Are you putting a target on your back? How do you handle audits? How do you view those things? Because I think most people I talk to, that's the big holdup is they're like, I don't want to go through that. If they see going through that almost as akin to like going through a legal case or something like that through the courts, which is not obviously the case. So anyway, can you just comment a little bit on that before we go into more questions?
Yeah, definitely. So there's definitely a range when it comes to strategies of very, very conservative to risky. And so different people have different risk tolerances depending upon the situation. At Cerebral, we don't put anything on a tax return we don't feel comfortable defending in the audit. And so happy to play in the gray areas, but we just have to feel comfortable defending it. And for example, the one that we went through together was a New York State. And the real reason why mentioning this is because Jordan has already written about it. So I'm sure
Yeah,
that he's
no, open
familiar.
book.
Okay.
Yeah.
Okay. Great. So that was a New York State audit for his selling needs real estate professional status. And sometimes audits are random and sometimes they are, it's just because this in this case it was in New York State, are just wanting to, make sure that people are following the rules. I did a 3-year fellowship in IRS representation. So obviously I'm very big on that tax savings, but I'm also very big on proper documentation, proper implementation, proper reporting, and proper documentation. So you shouldn't fear an audit if you know that you're following the law and you have that proper documentation. I mean, if everybody feared it, they wouldn't give a check to their church, but everybody does it because they know, hey, this is legitimate. I can give a $200 check to my church and I can get a deduction for it. I can report it. Now, if you get audited and you don't have that receipt, then yes, the IRS can deny that deduction. So that's where, when working with a tax professional, they should really be guiding you on what documentation you need and how long to keep those documents. So then that way, if the IRS or the state comes knocking, then you'll be ready for it.
That is super helpful and I think makes total sense and definitely is, you know, my view. And you have to, obviously you have to follow the rules. But as long as you're following the rules, then you can be confident going through these things as much as it, can seem stressful. In New York State, definitely they like to interrogate. Um, Frank
They
has
do.
a great question. Is there any improvement in the vehicle tax deductions in terms of like new purchases for business and in terms of like the weight of the vehicle? Are I guess number one, are there improvements? And then two, maybe if you could just go through what if there are not improvements, what those deductions are, how they can be utilized, and sort of what criteria it needs to meet.
Sure. Are you just talking about if you are purchasing a new vehicle or the EV credits that we were talking about earlier?
I think maybe Frank, if you can correct me, I think more so related to just like new vehicle purchase, um, period.
Got it. Got it. Yeah. So if you want to, use, like bonus depreciation or for the for purchasing a new vehicle, then in general you need to have it be over, 6,000 pounds. And and full transparency, I don't believe that there was any changes to that in the OBBBA. And so I'd have to double check that. But how it's been is that if you purchase a vehicle and it's over 6,000 pounds and you can qualify, and if you're using that vehicle 100% for business, then you can write off 100%. But if, let's say, you only use that vehicle 60% for business, then you can only write off 60% of that vehicle and any associated other expenses with it.
And you're basically tracking the mileage that you're using that car for, right? With like apps,
Jordan?
whatever documentation.
Oh, sorry, would you repeat that, please? You froze for a second.
Oh, sorry. And you're basically like tracking the mileage that you're using the car for to determine like what percentage you're using for business, right?
Exactly, yes. So even if your vehicle is 100% business, you still need to track your mileage. And the reason behind that is because the IRS needs proof to see, hey, where did you go and what was the business purpose of that mileage? I like to use mileage apps like MileIQ. They're wonderful. They really help to automate your mileage log by, they kind of, stay in the background. And let's say you drive and there'll be a notification that pops up that says, hey, you just drove 5 miles. Is this personal or business? And you swipe right if it's personal, left if it's business, and and then you can also tell it, make notes in it to say, hey, I went, from my home office to my place of work, or, to Staples for office supplies. And so it keeps a really nifty log, and you can actually teach it as well. So it knows like, hey, this is your home and that's the grocery store. And so every time you go to the grocery store, it tags it as personal. Or every time you go, between clinics, like my husband, he was the one who introduced me to MileIQ, and because he goes between hospitals and clinics and out to lunch with colleagues, et cetera. And so, he was able to, pretty much his whole mileage log now is automated for most of it. And so it just prints out a nice report at the end of the year. You can give that to your employer if they reimburse you, or you can reimburse yourself either for that mileage or apply the percentage to the to the vehicle expenses, like tires, gas, insurance, parking tolls, things like that.
Awesome. Yeah, it's like a swipe right or left. It's like a Tinder for your car. Um,
Yeah, exactly.
Randy has a great question. Does Cerebral offer prepaid tax audit protection? How do you charge for representation in field versus correspondence? That's probably a great opportunity just to even talk about your general kind of pricing structure. But I can answer
Yeah.
the question in short and say yes, as I've gone through it.
Yes, yeah. All of our maintenance packages include audit protection. If you were to receive a notice for anything that we prepare, you send it to us and we help you take care of it. And then also too, if we didn't prepare it, we're more than happy to take a look at it and help represent you. Just so you're aware, whether it's a CPA or an EA, which is what I am, an enrolled agent, we can only represent you up to tax court. Once you hit tax court, you have to work with an attorney. And so I just want to be aware of that. Luckily, I have, knock on wood, never ever had to do that. With actually having Cerebral since 2014, I've only done 2 audits. One was Jordan's, and then the other one was for a mortgage interest deduction that was being limited. And so unfortunately, the client had provided us some incorrect information. And so we just got it quickly dealt with, and we moved on. So but yes, so when it comes to audit protection, yeah, we include that in all of our maintenance packages. The way that we really start working together is I take your current situation and I look at how you make your money and how that money is being taxed and applying strategies that will help lower that liability and work towards your goals. So I'm designing a plan that's looking at your entity, retirement, deductions and credits. We're looking at those real estate, other alternative investments like oil and gas, opportunity zones, things like that. And it's all about that education. At Cerebral, we don't take any commissions or kickbacks on any strategies we recommend or vendors we recommend, and we don't sell any products. So everything is very education based for your best interest. I just want you to know your options so that you can make an educated decision on what strategies to move forward with. And then we are a white glove done for you firm. So we are implementing those strategies on your behalf and then reporting them properly on your tax return. And so that's a huge difference between us and other firms, is that we handle all of that implementation. And a lot of other firms know about the strategies, but they don't know how to implement them properly. And then the maintenance packages are all of your services for the year. It includes your tax preparation for your personal return and your business. It also includes the continued proactive planning. So we do a mid-year tax projection around the May-June timeframe, and then a year-end tax projection around October, November. And this helps to tweak and modify your tax plan at least a couple times a year for changes in your situation, changes in tax law, with quarterly estimated tax calculations, distributions, cash flow. Really, we're just trying to eliminate surprises. I want you to know what's going on with your tax situation a good 6+ months in advance. We also, if you have a business, we put your business onto QuickBooks Online. That subscription's included. And we're doing quarterly bookkeeping because all the tax planning in the world makes zero difference if you don't have good numbers to go off of. So that bookkeeping is super critical, and that's why we include that. And then, of course, we include that audit protection. We back up our work. We want to make sure that if you get that notice, you send it to us. I don't want you to worry about it. It causes anxiety. It doesn't cause me anxiety. Just give it to me, and I'll take care of it. We'll take care of it. And of course, we don't charge extra for additional questions, meetings, emails. Communication is a top priority for us. We have an internal policy of getting back to our clients within 24 to 48 business hours, never over a week. It's really important for you guys to know, that you can get quick answers and accurate answers. And that's what really makes Cerebral very different.
Yeah, no, I can definitely attest to that. And Alexa and her team are super responsive. Because I've definitely, she would never say it, but I'm sure I've annoyed the piss out of her a few
No.
times.
No. Oh my gosh, Jordan,
Randy
you're
has a
hilarious.
question. What is your audit rate of returns for real estate investors, and how many of these are no change versus tax court? Do you mean like, Randy, correct me if I'm wrong, maybe like how often you see an audit for real estate investors? It sounds like just
Yeah.
me, which I can
Just Jordan.
clarify.
You're just special, Jordan.
Like what that was, yeah. So it was this was for 2021, I think. So it was the first year that my wife qualified for and took real estate professional status. She also at that time was working as a fellow. She's a college professor, and so she had a fellowship where she was teaching two courses, I think, but she still ended up qualifying. She had more than 750 hours and many more hours towards real estate than she did towards her other job. But I think having her working at the same time as that was certainly like something that they wanted to check on and make sure we were doing it. So we just had to provide our documentation. So that's unique. But it sounds like, for your average run-of-the-mill real estate investor, kind of that stuff, you haven't had many audits or anything.
No, you've been the only one.
Um, and let's see, Mike, for 529 plans, what should we consider when deciding between using funds for K through 12, such as for tutoring now, versus leaving funds in the account for college? I can give you my 2 cents, then I'll turn it over to Alexis. I would say, leave it in there for college just to try and get as much compounding returns as possible. So you'll get more bang for your buck. And it certainly looks like college tuition is not going down anytime soon. That's my thought. I don't know, Alexis, what your thought is.
Yeah, I agree. That's my general sentiment. I think a little bit too just depends on your child or how many children you have, because if you let's say have a very let's say a sports centered child that hey, you know what, this child is a baseball prodigy and they're going to get some sort of scholarship or something like that, then you might want to start using it towards maybe college, excuse me, college, high school, for example. If you kind of see that coming down the road, it's a little bit of a prediction, but and then if you have multiple children, you can always go and let's say child number one doesn't end up using it because they get a scholarship. We can always change the beneficiary to the next child, and then that child can use it for college. Or if you have a child that's going to do some other sort of other vocation, that doesn't require college, and so it in general, I say yes, save it for college, because yes, college is, I agree, not going to go down in price. But you just have to look at it on a case by case basis.
Yeah, and there's as of I forget if it was last year or 2024, but they changed it so now if you have like leftover in the 529, you can convert it to a Roth IRA for that kid as well. So it doesn't you don't 100% then have to take the a penalty if it's not used for expenses. So if you're more so like your kid gets a scholarship and you weren't expecting to because like as a kid they were just hitting their head against the wall or something like that, you then you can still at least put it to good use.
Correct. And I believe that that conversion amount though is limited to, I'm just double checking, I think it was like 30 or
Yes,
35,000.
yes,
So
that's correct.
yeah, 35,000 lifetime. Yeah.
Yeah,
So it'd only be a small portion of it, but at least it's something.
yeah, yeah, exactly. Better than nothing. And um, so yeah, those are my thoughts on that. Um, Well, this is a perfect time to wrap up. This was awesome, Alexis, as always. Thank you so much. Definitely, I encourage everyone on the call watching in the future, be proactive about your taxes. As physicians, our number one expense is our taxes at 100%. Um, so definitely be proactive. Alexis, people who want to get in touch with you, I know it's here. Any other last kind of comments or best ways to reach you or thoughts?
Yeah, really the best way is to go to the website you see, cerebraltaxadvisors.com, and into the contact page. Also on our website has loads of information about the different services we have. We even have our pricing on there as well, very transparent about that. And so please go on there. And, if, also too, if you just have questions, you're more than welcome to email me directly. And, we still have availability for 2025, this 2025 tax return season. And of course, the earlier you start when it comes to tax planning, the faster I can save you more money, keep more of what you earn.
That's exactly right. All right, awesome. Well, everyone have a great night. Thank you for joining. Alexis, thank you again. And everyone we'll talk soon.
Thanks, everyone. Have a good night.